Today on the Joseph Carlson Show, last night we had the presidential debates. Maybe the one and only presidential debates of this season. We don't know for sure, but what we do know is that it was like looking at a train wreck. It was difficult to look at, but impossible to look away. Overall, the debates were received as a disaster specifically for President Biden. Bloomberg says Biden's disastrous debate accelerates doubts over candidacy. The Wall Street Journal says Biden's disastrous night stands to alter the course of the election. The Democrats needed to quell concerns about his fitness for office. Instead, he exacerbated them, allowing Trump to command the room. During the debate, the election betting odds for President Biden winning a new term plummeted and Trump's raised. I also threw out a poll during the presidential debate asking who's winning, and Trump had 85% of the vote. This debate really put into question whether or not President Biden can win a new term altogether. There's top Democratic fundraisers sounding the alarm, saying again that it was disastrous, terrible, it's game over. Biden's got to leave. He's going to get crushed. Ultimately, we don't know what's going to happen. Is Biden going to be replaced by a different Democratic nominee? Is President Trump going to continue competing with Biden and become the new president for a second term? Different presidents have had different impacts on the stock market, on the economy. We have a lot of data looking back into the differences and the possibilities between these two candidates. US Bank did a major analysis going over many of Trump's policies, things that could impact your portfolios if he becomes president for a second term. They also took a look at how different presidents have impacted the stock market over time. We can look throughout history, see the actual data, and what's the best thing statistically to do with our portfolios. So in this episode, we'll be looking at how to invest in the case of different election outcomes. Now, we also have some business news. Nike is down almost 20% today after their Q4 earnings. We'll be looking at the breakdown, their revenue segment, and analysis on what's going on with Nike. We also have another company we'll be looking at that's getting beaten up this year. Walgreens is down 53% year to date. And we'll be taking a look at the problems that Walgreens faces. And then finally, we'll be looking at the case of the stock-obsessed Gen Z that are using Astrology and Tarot to invest, and swearing by the results to the tune of over $400,000. Who are these Gen Z astrology investors? We'll be taking a look in this episode. So we have a lot to get to in this episode. Let's go ahead and jump in, starting off with the reaction to the presidential debates. Now, normally I don't cover a lot of politics. I'm not going to tell you who to vote for or what to do on specific policies, but this was a big event that affects the world and affects the markets. And this was a very, very bad night for President Biden. Now, out of all the reactions to this debate, I went through and tried to find what I thought was the funniest reaction, just the one that I thought was just the best reaction overall, and I think it comes here from Cenk. He is, I think, on the Democrat side, so he's a little bit more liberal-leaning, but he's from the Young Turks, a YouTube channel, and you can see here that he has fire in the background. It looks like that may be like the White House or something. I'm not sure, but he's got flames in the background of his screen here, and just listen to his reaction of this debate.
And the whole time the split screen is killing Biden.
Yep.
Because he's got his mouth open, he looks confused, doesn't know where he is. He's lost his train of thought at least twice in like disastrous shape. Those are gonna be played 1 billion times in viral video after viral video. This is an epic disaster. I see people online saying, well, okay, that answer wasn't so bad. No, it doesn't. Any particular answer doesn't matter at all. This thing is over. He looks like he's barely surviving. I don't mean the debate, I mean life. And so there's no person that has a single brain cell left in their head who thinks that Joe Biden is the best candidate to take on Donald Trump. You would have to be even crazier than Donald Trump to think that. This thing is over. I'll guarantee you this. I would bet show me a Democratic politician and I will bet them any amount of money that Joe Biden's going to lose this election if he's the candidate. It's a guaranteed loss. You're telling me this is the most important election of our lifetimes? You're telling me that democracy's on the line and you're going to put on a guy who can't even talk, who can't even sit there and look normal. This thing's a bloodbath. He's gonna get annihilated.
Now keep in mind, this is the Democrats' response to the debate. This isn't a conservative political commentator telling you that Biden's losing. These are people on President Biden's side having this reaction. Former Democrats and major investors like Bill Ackman are highlighting that this is basically a cover-up from the major media, saying that the mainstream media worked in concert with Biden to hide the extent of his physical decline. And overall, this is where things stand now. The Democrats have to deal with this situation, and many are suggesting that they'll swap out President Biden for a brand new candidate. Now, I've been investing through multiple presidential elections, and I remember them quite well. I remember that there's always concerns about the overall economy, about the world, like I think people should reasonably be concerned, but there's also concerns about the stock market. Many people believe that if their candidate doesn't win, the stock market is going to go down, or some policy is going to affect the world in a way that the stock market's going to go down. I first want to start by looking at the situation where President Trump wins a new term. Let's just go with the hypothetical that President Trump defeats Biden or whatever new Democrat nominee they replace him with if they replace him. There's a few things that President Trump will likely do if he regains presidency. The first one is on tax policy. This is possibly the one that will have the biggest effect on the stock market. It's called the Tax Cut and Jobs Act. That's the official name of it, but most people in politics refer to this as the Trump tax cuts. Even President Biden refers to this as the Trump tax cuts. This was a major tax cut that President Trump started during his presidency, and it did not end after his presidency. In fact, the Trump tax cut is still in full effect right now. It's been going on the entire President Biden presidency because it takes time for these things to be eligible to be renewed or expire. In this case, the Trump tax cuts will expire in 2025. So next year, these massive tax cuts are expected to expire. They say these tax cuts represented the most prominent domestic policy initiative in the Trump administration. Now, of course, President Trump says that he will extend this policy. Many people are concerned about the federal deficit. President Trump says that he will outgrow it. The goal here is to use the tax cuts to grow GDP. On the other hand, if President Biden or someone else ends up winning presidency and certain or all of the provisions in the tax cuts aren't extended, tax rates could be higher for up to 60% of filers. Other expiring provisions would impact standard deductions, child tax credits, and estate and gift exemptions. The big one for the stock market is for corporations. An expiration of the Trump tax cuts would result in top corporate tax rates moving from 21% back to 35%. It's difficult to actually say the impact that would have on different companies, but allow me to illustrate just for instance, just an example of how those additional corporate taxes affect different discounted cash flows. If we look at the example of Intuit, just a random company in this case, we can do our normal discounted cash flows. We can say the company's going to grow at a rate of 13%. They're going to have EBITDA margins of 30%, capex to revenue ratios of 1.6 with medium predictability. Qualtrim generates a 5-year projected financial for the company, and it takes in the historical tax rate this company has been paying for the past year. When we look at that, that's around an effective tax rate of 15%. In the case that President Biden wins again and he does not extend the Trump tax cuts, the corporate tax rate would move from 21% to 35%. The effective tax rates for most companies could go up anywhere from 7% plus, meaning that instead of paying around 15% in this case, it would be bumped up to around 22%. If we look at the accumulative free cash flow based on 15%, the estimate is for $6.3 billion in free cash flow in 2028. If you bump up the effective tax rate from 15% to 22%, it goes from that $6.3 to $5.7 billion of free cash flow in 2028. Less free cash flow means that the future expected returns of these stocks goes down. There's a lot of different ways that the presidency affects the economy and in turn affects the stock market. Through foreign policy, through the sentiment of investors, through a lot of different ways. But I still believe that the most direct way the presidency affects the stock market is through taxes. Taxes are a direct way of affecting the cash flows of a company, and this would have a massive impact on the free cash flow of companies. In fact, I believe that this would be such a significant and jarring development for the economy and the stock market that even if President Biden wins, I think there's a chance that he will still keep a lot of the provisions. He'll probably rebrand it and kind of rewrite it in a different way, but I still think there's going to be less of an impact than a total removal of the Trump tax cuts. The other big policy that President Trump is likely to implement is tariffs. He loves tariffs. If you listen to President Trump on different podcasts or interviews, he really likes the concept of tariffs, particularly on China. But this is one case where it's another thing that President Trump talks about. In fact, he's a lot more vocal about this, but it's a case where President Biden seems to like tariffs as well. He just doesn't like talking about them as much. During his term as president, Trump implemented tariffs, and President Biden continued most of them and recently added more tariffs, reflecting a move away from the previous free trade policies. Both of them have extensively used tariffs. So I see less of a difference in terms of impacts on the economy or the stock market in regards to tariffs. Now, the big question is, as investors, it becomes scary when we're looking at these presidential debates. In my opinion, it's somewhat embarrassing for our country. I feel like we have such smarter and better people, better candidates that could be arguing with a lot better debates. But these are the two people we're stuck with. It's difficult to have confidence in the future of the US when we're looking at debates like this and we're seeing who's actually running the country. But this has been the case again through most elections. Most elections are full of vitriol, disagreement, lots of contention, people that are anxious and concerned about the future. Things are never quite as bad as people predict. We can look at how different capital markets have reacted to different presidencies and what the potential ramifications are for investors. US banks said to better address this question, strategists studied market data from the past 75 years and identified patterns that repeat themselves during election cycles. Overall, the analysis points to minimal impact on financial market performance in the medium to long term, based on potential election outcomes. The data shows that there's more of a correlation of the stock market to economic and inflation trends over election trends. We can look at the S&P 500's performance under certain conditions. We can filter it by whether we have a Democratic president or a Republican president, and then even go further, filtering it down to whether or not we have a Democratic president with a Democratic Congress, or a divided Congress, or a Republican Congress, or we have a Republican president with a Democratic Congress, divided, or Republican. I notice a few interesting things about these results. When you have the Democrats control everything in the House and the Senate, and then you have the Republicans controlling the presidency, that is the worst results. We have 4.9% returns under those conditions. Now, the best performing combination is when the Republicans control presidency, but the House and the Senate are divided. That's where we get optimal performance, 13.7%. Then we have a few cases in between. When we go to the side of when we have a Democrat president, we have the worst results when the Democrats control everything. When they have the presidency, the Senate, and the House, it's still a positive return, but it's the lowest out of the three. When the Democrats control presidency, but Congress is divided, the Senate and the House are controlled by both the Democrats and Republicans, the returns go up to 13.6%. Almost the exact same as when the Republicans control presidency and the House and Senate are divided. And then we have similar returns, but not quite as good, when we have a Democrat president and a fully Republican Congress, or a Republican president and a fully Republican Congress. According to the data, and again, this may come across as political, but this is just what the data says, it is better to have a fully Republican Congress, Senate, and presidency than a fully controlled Democrat Congress with a Democrat president. So I understand that there's many other bigger and more important considerations when looking at who to vote for presidency. But if you were just singularly concerned, hypothetically, about what's going to impact your stocks the most positive way, by far, the best outcome is to have a divided Congress. The best outcome is a divided Congress. And I believe that's because investors overall like certainty and predictability. And having different opinions and different voices that in many cases gridlock Congress is actually a good thing for investing. The other big takeaway from this data is that no matter which combination you get, any of these varying combinations, you still have positive returns. It's still better to stay invested no matter who wins or who controls the house, no matter if they control everything or nothing, than to not invest at all. It's like the rest of you, I can't say what's going to happen. I have no clue if President Biden's going to be replaced with someone else, or if he's going to continue to compete, if there's going to be more debates, or if Trump will end up winning. It's impossible to say. But as an investor, I've seen this before. I've seen the panic and fear from elections not working out the way people want them to. I've seen it over and over again, and every time I've stayed invested, it's been the best decision. Now moving on, we have some business news that Nike just reported their Q4 results. In their latest report, they gave soft guidance, and they're now being downgraded by analysts. Saying that it was soft guidance, I think, is actually an understatement for how bad this guidance was. The world's largest sportswear company sees revenue declining in the mid-single digits in the company's current fiscal year, which began this month. Analysts had expected growth of around 2% this year, according to estimates. So this was a huge discrepancy between where analysts were at, where the street was at, and what Nike's actually saying. Analysts were expecting 2% growth, and now they're guiding for revenue declines of mid-single digits. So instead of growing by 2%, they're going to decline by 5%. That right there is enough to cause any stock to drop 20%. This 18% decline this morning is the biggest drop that Nike has faced since 2001. So this is historically a compounding machine, a company that's very reliable, that's grown revenue routinely year after year, and they finally seemingly hit a wall. If we look at the revenue breakdown of Nike, we can illustrate the issue here. We have different KPIs in Qualtrim. One of them is seeing the overall revenue, and then a revenue by segment. When we look at all of them combined, the company shrunk by 0.62% year over year. So revenue is already in a decline, and even over the past 5 years, it's only grown around 5%. So Nike's becoming a slow-growing and now even shrinking company. That's not a good picture for this company. But if we look at the different divisions of revenue, we can see a clearer picture. If we look at footwear, their biggest source of revenue, this is in a greater decline than their overall revenue, meaning that their apparel is holding up better than footwear. In fact, apparel is actually growing, 2.75%. We can look at equipment. This is actually doing fantastic. So they're growing in their equipment. Unfortunately for Nike, this is a tiny fragment of their revenue. It's just not big enough to make a meaningful difference. And then global brand division is so small, it basically doesn't matter. I may as well take that one out of the revenue segment. But there you have it. The overall revenue shows that apparel's doing okay, equipment's doing okay, the global brand division's doing okay. The part that's suffering is the footwear. And where are the problems happening with their footwear? The problem with Nike footwear stems back to the fact that they have lost track of the running market. They've disconnected from runners, and they've let lots of new competitors get into this space, take market share, and take brand equity. Brendan Egg's running group in Portland, Oregon has roughly quadrupled in size in 2021 to around 80 runners. So we have this running group in Portland, Oregon, and they say that that doesn't include the representatives from New Balance, Hoka, and ASICS who regularly show up to their events and let their runners try new sneakers, give out free merchandise, and pay for drinks after a workout. So you have these other brands, New Balance, Hoka, and ASICS. They all offer really good running shoes. They're going up and meeting with small groups of runners, groups of 80 people who are really into the sport of running. These are your core audience. These are the people that are trendsetters, that are going to all the running shops, that are trying out all the best running shoes. One local giant that has been conspicuously absent from the road running scene is Nike. In the 3 years I've led this group, there have only been 2 Nike road demos. I feel like I've seen the Hoka rep 4 times this year. Nike, which has long monopolized the attention and wallet of avid runners, in recent years has shifted its focus to other areas of its business, including the release of limited edition sneakers. Competitors took advantage of this, resulting in an increasingly fragmented market, and this is denting Nike's financials. I've seen the same thing happen. I recently went to a running shoe store. This was like a real hardcore running shoe store where all the people working there run miles and miles every day. They know everything about every shoe. They try them all out. They have a running track around the store so that you can try out different shoes. And right when I got there, I was asking them, what are the best shoes? What are the best sellers? And they routinely, every single one of the staff, never really recommended any of the Nikes. In fact, they weren't even really in the conversation. They recommended the Ons, the Hokas, the ASICS, the New Balances. There are so many other shoes that they're recommending over Nikes. It was startling to see that Nike, the once dominant brand in running, has really let this portion of the company go. They let competition step in and take brand equity from running. Nike is no longer considered the go-to running shoe. They're not even close anymore. Nike shifted from their focus on high-level, innovative running shoes to their focus on limited edition sneakers with different styling. They're basically focusing more on their casual brand, your wear-around everyday brand, than they are their athletic running shoes. This wasn't a good move for Nike, and executives are acknowledging it. They're saying that they've lost ground in the critical running category, and they say they're doubling their efforts to regain a stronger grasp of the market. They're betting that a new line of shoes will give a boost during the Paris Olympics this summer. And if you go to Nike right now, you can tell that this is their major focus. The first thing that shows up on their website, Nike.com, is a Nike Pegasus. They're pushing their new line of running shoes really hard right now, but it's always more difficult to make up for lost market share than to not lose it in the first place. The reason that I sold out of Nike long ago was because I knew that there was a lot of competitors taking market share from the company. I could see all of these different brands really competing fiercely with them. Not only in the running category, but different brands like Lululemon, with athleisure. There's so many different companies that are also high quality, all trying to eat away at the biggest winner here. Without anything that I consider to be a substantial moat against these competitors, it's difficult to want to invest in this company with a valuation that doesn't leave a lot of room for error. So even though Nike's down 20%, and we could have a quick recovery in the stock, as of right now, I think they're facing too many fundamental problems. I invest in companies that I believe the fundamentals are becoming stronger. Next up, we have Walgreens, another company that just yesterday dropped like another, what is it this time? Another 21%. Add that drop onto the beginning of the year, and the stock is now down 53% year to date. Walgreens has been a disastrous investment. It's been a value trap and a company that I think investors should continue to avoid. Walgreens is now saying that they're going to close a substantial number of poorly performing stores and pulling back on the company's plunge into the primary care business. You know, I could go into Walgreens and go over all their troubles and concerns and woes this company faces, but it's really simple. Why invest in Walgreens when Amazon exists? I would never invest in a company like Walgreens so long as Amazon exists. Amazon basically does every single thing that Walgreens does, except they do it better and more efficiently. They do it with a better customer base. They do it more profitably. Amazon is a destroyer of Walgreens. Amazon sells almost everything Walgreens sells except for grocery. And Walgreens doesn't sell a lot of grocery. Amazon is also in pharmacy, which is another major part of Walgreens. I don't believe there will be any turnaround for Walgreens. This company is going to continue to struggle as Amazon grows. Now finally, it's always good to hear the investing advice of other people and see their input on the subject. In this case, we have an article here from Fortune saying that stock-obsessed Gen Z are using astrology and tarot to invest, and swearing by the results to the tune of over $400,000. Some investors may ask their brokers for trading advice. Young people are consulting the stars and sky. Stefania Nova, who goes by Blonder Witch on TikTok, is a 25-year-old living in New York City, using astrology, tarot, and intuition to guide her day trading. She says, quote, "After scanning the market from 8:30 till 9 a.m. and picking the stocks I'll be trading that day, today it was Amazon, I do a single card pull to confirm my decision to get guidance. Today I pull the Ace of Cups, which represents abundance. This gives me the needed assurance to trust my strategy." This process seems to be working for her. On the next slide of her TikTok, Nova posts a screenshot of her portfolio that day, showing an almost $300 gain from trading Amazon's shares. Quote, "A 21% return in 8 minutes by trusting my high self heart." In another video, she posts a screenshot of her monthly earnings of almost $6,000. So to summarize so far, Nova, this TikToker, is using intuition, astrology, and picking different cards to determine how she trades different stocks. And she's displaying these great returns of 21% in 8 minutes and screenshots of her $6,000 gains in a month. Nova is one of many TikTokers to ascribe her financial success to their trust in the universe, touting techniques like using lunar cycles to buy Bitcoin and astrology to make $440,000 in crypto trading. The practice, while far-fetched compared to the conventional strategies of sophisticated investors, is at the intersection of Gen Z's love of vibes and financial freedom. It's a new way of making money, Nova told Fortune, new possibilities for people, that you don't have to, in this day and age, work as hard. Work smarter, not harder. You know, one thing that disappoints me from all these people promoting these type of ridiculous investment strategies based on nothing but how you feel and good vibes is that the journals doing this, different publications like Fortune, they just go through the entire interview, asking questions, letting them share all their ridiculous statements, and they give seemingly no pushback at all. There's no scouring for evidence. There's no even requiring that there's any evidence given, other than the TikToks, which are selectively edited to promote something that isn't true. The idea that you can make money easily and effectively and without much work by day trading based off of astrology. It's already enough that they share these preposterous ideas to a huge audience on TikTok without any pushback at all, but then they do so again on big publications like Fortune. Why is everyone okay letting them share this type of nonsense with no pushback and requiring no evidence at all? The unfortunate truth is, as ridiculous as this type of story sounds to the majority of us, there is going to be a young, impressionable group on TikTok that believe this, that follow them, that are impressed by this to try the same thing, and they're going to lose a lot of money in the process. Day trading alone doesn't have predictably good results for the majority of people, and doing so based off of something like astrology is not going to improve the results. The only good news that comes from articles like this is that this illustrates the market efficiency. This illustrates who you're competing with in the market. You're investing in companies that are free cash flow positive, that are compounding machines, that are growing in revenue and cash flows every year. And your competition, many other people in the market are investing off of vibes, off of their fills. So there you have it. There's some of your Gen Z competition, investors in the market that are brand new and they're pricing things based off of the stars. Now that's going to be it for this episode. If you like this type of content, you can check out the Patreon. There's more exclusive episodes and you get access to qualtrim.com. Other than that, I'll see you in the next one.